We're now facing a world of many potential outcomes.
Americans can rest assured that our banking system is safe.
The pressing question on everyone's mind is just how severe this recession will truly be. It's concerning to see that the average person in America is saving a mere 3.7% of their income, which is only about a third of our historical average since 1959. This alarming trend can be attributed to wages failing to keep up with the increasing inflation, which has persisted at over 5% for a staggering 22 consecutive months. To combat the rising inflation, Americans are resorting to borrowing more money, plunging themselves into deeper debt. This is evident from the nearly $1 trillion of credit card debt that has accumulated. Not only is this the highest level ever recorded by the Federal Reserve Bank of New York, but it also marks the largest yearly increase on record, surging by $130 billion. Moreover, credit card annual percentage rates, APRs, have skyrocketed to almost 20%, the highest level seen since 1985. The discrepancy between record-high credit card debt and near all-time low personal savings rates is cause for concern. Unfortunately, this mounting debt comes due at a time when interest rates are rising at an unprecedented pace, surpassing historical records. Consequently, this has led to a vicious cycle of increasing debt, fewer job opportunities, and heightened instability in the financial system. In summary, individuals are facing a situation where their incomes are decreasing, leading them to save less. As a result, they are compelled to borrow more out of necessity. In this video, I aim to shed light on the implications of this economic situation for investors, the middle class, and provide insight into the potential severity of this recession. So, without further ado, let's delve into the details. When it comes to the recession, we may not currently meet the technical definition of 2 consecutive quarters of negative GDP growth. However, the likelihood of a recession is increasing, and there is ample evidence supporting this notion. For instance, while the economy added 236,000 jobs, resulting in a decrease in the unemployment rate from 3.6% in February to 3.5% in March, the rate of job growth is actually slowing down. The latest report from the Labor Department reveals a decrease of 700,000 job openings, dropping from 10.6 million to 9.9 million. On a positive note, there are still approximately 1.7 job openings for every worker in the United States. However, it is worth noting that when considering inflation, the data on increasing incomes becomes less encouraging. Incomes were up by 4.2%, but when factoring in the Consumer Price Index, which economists use to measure inflation, it was up by 6%. As interest rates rise in an effort to combat the 6% inflation and bring it down to the Federal Reserve's desired 2%, certain jobs will be more vulnerable than others. While the tech industry was the first to experience job losses, the impact is now extending to other sectors such as retail, construction, and manufacturing. Even companies like McDonald's, typically considered consumer staples and less susceptible to business cycles, are beginning to make cutbacks. Since October of the previous year, 760 companies have cut 538,000 jobs, with 240,000 of those job cuts originating from just 20 companies, including UBS, Credit Suisse, Amazon, and Meta. The data undeniably indicates a slowdown in the economy, aligning with the Federal Reserve's objectives. The key question is how this will affect the middle class, and what are the odds of a recession? According to statistics, the likelihood of a recession surpasses 50% by 2024, slightly worse than the odds of a coin flip. Economists arrive at this conclusion by examining something called the inverted Treasury yield curve, which has accurately predicted all 10 recessions since 1955. Interestingly, 1955 was also the year when Doc Brown invented the flux capacitor, a reference to the movie Back to the Future. You may have come across the term inverted yield curve from last year, but in case you haven't, let me explain. It examines the interest rate on long-term bonds, particularly the 10-year Treasury bond, in comparison to the 2-year Treasury bond. Here's a simplified way to think about it. When investors purchase bonds, the longer it takes for those bonds to mature and return our money, the more profit we expect to earn. This makes sense due to the concept of opportunity cost. Just like if you were to borrow money from me for 10 years, I would charge a higher interest rate than if you borrowed it for only 2 years, as the longer duration carries more risk. In a healthy economy, this relationship holds true. However, when the economy takes a downturn and high interest rates start hindering it, which is precisely what is happening now, it negatively affects the middle class and job prospects. Consequently, people begin anticipating the Federal Reserve to lower interest rates to stimulate the economy once again. Historically, such a scenario has been a troubling sign for the economy. At present, the inverted yield curve is exceptionally steep, not seen like this since the 1980s. Examining the timeline reveals that each time this line dipped below the zero trend, a recession followed shortly after. Even when the line eventually corrected itself, it failed to prevent the occurrence of a recession. If a recession were to happen, short-term effects would include persistently high or even higher inflation. OPEC's recent announcement of oil production cuts contributes to this, as energy costs account for 7.5% of the overall inflation index. Already, the cost of a gallon of oil has increased by 15 cents from the previous month, and Americans feel inflation most acutely at the gas pumps. Furthermore, lending data indicates that domestic banks are tightening their lending standards, meaning individuals seeking loans for purchasing cars or homes would require higher credit scores, greater income, and larger down payments. Another long-term consequence of the current state of the economy is the weakening of the US dollar. This means it will be increasingly challenging to export dollars overseas since countries prefer trading in their own currencies, resulting in fewer dollars leaving the US. Consequently, the US cannot rely on printing money to alleviate debt, leading to increased inflation as more dollars remain within the country. Arguably, the most significant concern looming over the economy is the state of commercial real estate. There is growing anxiety surrounding the multi-trillion-dollar commercial real estate industry, with analysts from Moody's finding that nearly a third of office buildings in the top 80 metros could become obsolete. Billions of dollars in commercial real estate loans are due this year, and experts predict prices could plummet by as much as 40% over the next few years, reminiscent of the aftermath of the banking crisis experienced with the real estate market. A total of $1.5 trillion worth of loans is set to mature before the end of 2025. Normally, this wouldn't be a significant issue as refinancing is a common solution. However, interest rates have more than doubled since then, making these loans much more expensive. Additionally, most of these loans are held by smaller banks that are already facing difficulties. If the Federal Reserve continues to raise interest rates, these banks could face insolvency. Furthermore, the commercial real estate sector is still recovering from the impact of the pandemic, with remote work reducing the demand for office space. Stricter lending standards compound these challenges, raising concerns about who will provide loans to potentially insolvent banks and what will happen to property values. Some estimates suggest that commercial real estate could experience a 40% decline due to these factors. While it's important to consider these predictions, it's crucial to understand the elements necessary for a prediction to hold value. A prediction should identify the what, the event, the why backed by data, and the when, the timeline or trigger. Without these elements, predictions lack reliability. Instead of relying on predictions, it's more beneficial to analyze data for personal investment decisions. Examining the data, the yield curve inverted in July 2022, indicating a 57% chance of a recession starting by late December 2023 and a more than 95% chance by late July 2024. While a recession seems inevitable by late 2024, there is a silver lining. Historical data from J.P. Morgan's Wealth Management Report shows that investors who bought U.S. investment-grade bonds after the last rate hike experienced an average 26% return over the following 2 years. The key is knowing when the last interest rate hike will occur. To determine potential interest rate hikes, the CME Fed Watch tool is useful. Currently, there's a 28.8% chance that rates will not increase and a 71.2% chance of a 0.25% hike, which could be the last one. Paying attention to this tool can provide interesting insights, although trying to time the bond market might not be the best strategy for everyone. In summary, while the challenges and predictions surrounding the economy exist, personal financial control and investing in low-cost index funds remain crucial for long-term stability.